32 million copies. Rich Dad Poor Dad is one of the best-selling personal finance books ever written. And the man who wrote it, the man who told you to build assets, avoid debt, and never rely on a paycheck, filed for bankruptcy. Not fiction. His company, Rich Global LLC, filed Chapter 7 bankruptcy in 2012 after a court ordered him to pay $23.7 million he didn't have. The same man now publicly boasts about carrying over $1 billion in personal debt. Here's the thing though, none of that means the book is wrong. Some of the ideas in Rich Dad Poor Dad are genuinely life-changing. The problem is, most people who read it extract the wrong lessons entirely. By the end of this video, you'll know exactly which ideas to keep, which to throw away, and the one lesson buried in Chapter 3 that nobody talks about, but the wealthy quietly use every day. Robert Kiyosaki published this book in 1997. It sat on the New York Times bestseller list for over 6 years. Generations of people read it and felt something shift. The core premise is simple. Kiyosaki had two father figures growing up. His biological father, a highly educated government employee who struggled financially his whole life. And his friend's father, a man who never finished the 8th grade, who became one of the richest men in Hawaii. Same economy, same era, completely different results. One followed the script, study hard, get a good job, work for money. The other wrote his own, understand money, make money work for you. Here's the problem with how most people read this book. They finish it feeling inspired. They understand the concept of assets versus liabilities. They nod along to the idea of passive income. And then they go back to work on Monday and nothing changes. Because the book gives you the mindset, but most people miss the actual mechanism. These are the 5 ideas that actually move the needle. The ones most summaries skip entirely. Cheat code number 1. The rat race is a feeling, not a number. Most people think the rat race is about not having enough money. It isn't. Rich Dad explained it to a 9-year-old Kiyosaki using 2 words, fear and greed. Fear of not having money makes you take the job. The paycheck triggers greed. You want more things. You spend. You need the next paycheck. The cycle locks in. Here's the mechanism people miss completely. The rat race isn't a salary problem. It's an emotion management problem. Kiyosaki watched people get raises and immediately expand their lifestyle to match. More money, more expenses. Same trap, just at a higher altitude. The research confirms this. A 2021 study from Purdue University found that beyond a certain income threshold, more money actually decreases emotional well-being because spending increases faster than income, creating more financial anxiety, not less. The rat race exits when you stop letting fear and greed make your financial decisions, not when you earn more. Real application? Before your next financial decision, a purchase, a job change, a loan, pause and ask honestly, am I doing this from fear or from strategy? That single pause is worth more than any investment tip. Coming up, the idea that sounds obvious, but almost nobody actually does. Cheat code number 2. Your house is lying to you. This is the most controversial idea in the book, and Kiyosaki was right. Most people believe their home is their biggest asset. Rich Dad said that is precisely the belief that keeps most people poor. Here is the definition that changes everything. An asset puts money in your pocket. A liability takes money out. By that definition, your house for most people is a liability. Mortgage payments flowing out, property taxes flowing out, maintenance costs flowing out, insurance flowing out. Unless that house is generating rental income that exceeds all those costs, it is not an asset. It is an expensive liability that feels like an asset because it appreciates over time. The Indian context makes this even sharper. In cities like Mumbai and Delhi, A 1 crore rupee apartment generates roughly 20 to 25,000 rupees per month in rent, a 2.5% yield. Meanwhile, EMIs on the same property cost 70 to 80,000 rupees per month. The gap is coming out of your pocket every single month. The rich build asset columns first, then buy houses. Most people do it the other way around and wonder why they feel stretched. Application: draw a simple T chart tonight. Left side, everything that puts money in your pocket monthly. Right side, everything that takes money out. The ratio of left to right is your actual financial health, not your net worth, not your salary. Next, the McDonald's lesson that MBA students got completely wrong. Cheat code number 3. You are not in the business you think you are. In 1974, Ray Kroc, the man who scaled McDonald's, gave a talk to MBA students at the University of Texas. He asked them, "What business am I in?" They laughed. "Hamburgers, obviously." Kroc smiled and said, "I am not in the hamburger business. I am in the real estate business." McDonald's today owns some of the most valuable real estate on earth. The hamburgers are just the reason people come to the location. The location is the actual wealth machine. This is lesson 3 in Rich Dad Poor Dad, and almost every summary of this book misses what Kiyosaki is actually saying. He is not telling you to start a business. He is telling you to identify what the real asset is underneath whatever you do. A doctor's real asset is not their hours, it's their knowledge base. A teacher's real asset is not their salary, it's their ability to package and sell information. A cop's real asset is not the badge, it's their authority, psychology expertise, and credibility. Most people monetize the surface. The wealthy monetize the underlying asset. Application: ask this question about your current work. If I could not trade my time for money in this field, what asset do I have that would still generate income? That answer tells you what to build. Cheat code number 4. The tax system is a game, and you are playing without knowing the rules. This is the lesson most people nod at and never act on. Here is the mechanism explained simply. An employee earns money. The government takes tax first. Whatever is left, the employee spends. A corporation earns money. The corporation spends on legitimate business expenses first, then pays tax on whatever profit remains. Same income, completely different sequence, dramatically different tax bill. Kiyosaki's rich dad taught him this as a child. The wealthy understood for centuries that the corporation is not a building or a team. It is a legal structure that changes when you pay tax. This is why the Forbes list is full of people who appear to earn modest salaries but build extraordinary wealth. Their corporations pay for cars, travel, education, meals, equipment, all before the tax calculation happens. India Unko, this structure is available to everyone through a private limited company. But less than 3% of self-employed individuals use it. Application: if you have any form of self-employment income, freelancing, consulting, rent, a side business, speak to a CA this week about whether a private limited structure makes sense. Even 5,000 rupees in saved tax per month is 60,000 rupees per year that compounds into your asset column instead of disappearing. One more. This one is about why financial knowledge beats financial advice every time. Cheat code number 5. The 5 obstacles and the one that kills most people. Kiyosaki lists 5 reasons why financially educated people still fail to build wealth. Fear, cynicism, laziness, bad habits, arrogance. Every summary you have ever seen covers these 5. But every summary misidentifies which one is actually the killer. Most people assume it is fear. It isn't. The one that destroys the most people is cynicism. Here is why. Fear at least keeps you alert. Fear makes you cautious, which sometimes protects you. But cynicism convinces you that the opportunity isn't real before you have ever investigated it. Kiyosaki describes it as the Chicken Little syndrome. The sky is always falling. The market is going to crash. Real estate is too expensive. Crypto is a bubble. The economy is rigged. Every piece of negative news feeds the belief that taking action is foolish. So no action is ever taken. The research backs this. A Harvard Business School study found that pessimism feels more intellectually sophisticated than optimism, meaning cynical people often believe they are being smart when they are actually being paralyzed. Rich Dad's solution was simple. Instead of saying, "I can't afford it," ask, "How can I afford it?" The first statement closes your brain. The second forces it to find solutions. Replacing the statement with the question is the cheapest financial upgrade available to any human being. Application. The next time you hear about an investment, an opportunity, or a financial strategy, before your brain generates the reason it won't work, force yourself to ask one question first. Under what conditions would this work? That one reframe has built more wealth than any stock tip. The truth. What the book gets wrong here is the honest version that no summary gives you. Rich Dad Poor Dad has 3 real problems. First, Rich Dad may not have existed. Smart Money magazine investigated this in 2003 and found no evidence of the man Kiyosaki describes. Kiyosaki has changed his story about Rich Dad's identity multiple times. The book is sold as non-fiction. This matters. Second, the real estate advice is dangerously context-specific. Kiyosaki built wealth in 1970s and 80s Hawaii, a specific market, a specific era, using borrowed money in a low-interest environment. Applying that same playbook in 2025 India or America without understanding the differences in yield, leverage cost, and regulation is how people go broke. Third, the book is, by Kiyosaki's own admission, an advertisement for his seminars. He has said publicly that the book was designed to sell higher-priced courses. The information ends exactly where the real instruction would begin. The fix. Take the mindset framework entirely. Assets versus liabilities, cash flow thinking, financial education, these are universal and genuinely powerful. But verify every tactical claim against your specific market before acting on it. The action. One thing to do today. One action. Tonight, before you sleep, write 2 columns on a piece of paper. Column 1. Everything in your life that deposits money into your pocket without you trading time for it. Column 2. Everything that takes money out every month. Count the items in each column. Most people have 0 items in column 1. That is not a salary problem. That is a starting point. Your only job over the next 12 months is to add 1 item to column 1. 1, not 10. 1. Income generating asset that functions without your direct time. That single shift is what separates the 2 dads in this book. The ideas in chapters 3 and 4 of this book are worth reading in full, especially the tax and corporation sections. They go into detail that this video cannot. The link to Rich Dad Poor Dad is in the description. If you prefer audio, the Audible link is there too, and it reads well as an audiobook. Subscribe to Page Edge if you want one book broken down like this every week. The real ideas, the honest critique, and the one thing to do with it. One cheat code every week. See you next time.